Hello, and welcome to your Daily 5. My name is Greg Harmon. I'm the founder and president of Dragonfly Capital. At Dragonfly Capital, we manage portfolios for clients by using technical analysis and options strategies to mitigate risk and mirror or beat the S&P 500 with minimal capital risk. We do this in separate accounts for clients so that there's full transparency 24/7. Any reporting that you like from our broker-dealer interactive brokers. We also sell a newsletter that talks about how you can learn how to do this yourself through understanding some technical analysis and some option strategies to come up with ideas on a weekly basis. Find out more at dragonflycap.com. This week, we're going to talk about the macro picture. I've talked about it the last few times in that it's not been so clear what is going on. There have been diverging signals. But today, I want to tell you that I think that the macro picture is clearing. And it started clearing the day that we got the last CPI report last week. So let's start with a chart of the US dollar. And when we look at the US dollar, we can see that we had a bit of a breakout here, moving back up above this resistance level that had put us into a position of getting more favorable on the dollar and the strengthening of the dollar, which would be weakening for the stock market. We saw that the price of the dollar index, though, did hover around and has finally now, with that news from the government about CPI prices falling, broken back down through this. If we look through here, we've got a classic harmonic pattern that's developed here called a shark that looks like it triggered here at the top as well. And now we're starting to see a reset lower. So we could look to see for a move down to about the 101.50 level in the dollar based on this. And that would be a positive for stocks. We'd see momentum is falling off as well. From a lower high and a lower high in the MACD as well, with a cross down now. So that's a positive for equity markets. Moving on to oil, we had also a breakout in oil and a move up to nearly 52-week highs. It got up to, I think it was like 48 weeks or something like that. A bounce back to support, a little bounce to a lower high. And then we see this momentum divergence develop as well. And now we've had 4 solid weeks of moves lower. We're going to get today a little bit better of a little bit longer of a bottom candle tail on today's candle as it prints, because we've got a little bit of a bounce coming into the end of the week today. We see that volume start to slow down. So we may be at the bottom here. Or we may come back and touch the 200-day at around 70 as well. But this is also a positive in that inflation, oil prices, commodity prices are not getting crazy out of hand at the moment, and we're starting to see lower peaks and better pricing. Third one is gold, and this has been the one that's been the most stubborn, as we've seen that. We've been hovering around this 2000 level for a really long time. We're bouncing up again today. We're going to start to see a little bit better price action here. And it had looked as though we had a falling channel that was going to take hold. And then we had a breakdown out of that, a false breakdown. And as we say, false moves come fast moves, a fast move to the upside and through the channel to a higher high. A pullback, and now we're pulling back to a higher low and confirming that with the move higher this week. So it's questionable at this point, but if you look at the expanding Bollinger Bands, the direction of momentum on both the MACD and the RSI, we're starting to get to see more of an upside bias to gold again. So this 2000 price level has been very sticky, and we're still hanging around that level. So this one is the one that's still not all as clear as everything else. So how does this play out when we start to look at equity markets? Here we have the Nasdaq, and if we look at the Nasdaq from the COVID low up to its high in the end of 2021, we saw almost a perfect pullback to 61.8% of the move higher, a very important Fibonacci retracement level, a move back up. We got started to think about getting long at this breakthrough above the interim high here for a first new high. Moved up to another new high above the April and March 2022 highs, and then kind of pulled back a little bit, and people started shaking their heads again. But what we're seeing now on the third week of upward movement is that this has kind of traced out a cup and handle pattern. And the cup and handle pattern, you know, I don't want to get crazy here, but when we've got about 16,000 on the height here on the side and about 10,500 over here, another 5,500 on top of that is 21,500. That's a lot higher than where we are right now, and a lot higher than the Nasdaq has ever been. So the Nasdaq's starting to tell us that all-time highs are on the way, and it's time to get on board. We see that same cup and handle starting to form in the S&P 500 as well. It's not quite as strong of a picture as what we saw in the Nasdaq, but a really good picture. This one we see from the COVID low to the high at the end of 2021, a 50% retrace almost to the penny. Touch at the 200-week moving average as well. Move back up, higher highs here above the March 2022 highs, and a pullback that was just a corrective pullback in the little over 10% range that got us into now 3 full weeks of moving higher, and a move back over this 4650 level would give us the trigger on the cup and handle here that would get us from 3,500 to 4,600 is nearly it's a little over 1,000 points. So talking about 5,700 on the target for the S&P 500 based on that. Not going to be a straight line if it goes that way, but that's a lot higher than where we are now, and poses a very bright picture for the S&P 500 moving forward. Momentum is confirming that, as well as now a upturn in the accumulation distribution statistic. So all in all, the picture is getting a whole lot clearer as to what the future of equities is going to look like, and it's looking pretty bright right now. So that is your Daily 5.